On the cusp of a new millennium, the echoes of Wall Street's jubilant winter still hangs in the air. Yet, as spring arrives, the tech bubble, bloated and unstable, finally bursts. Its implosion reverberates far beyond the confines of the Nasdaq, shaking hedge funds across the nation. At the heart of the chaos stands one man, a man whose decisions, in the face of mounting losses, could either forge a path to unprecedented victory or lead to a catastrophic bankruptcy for his fund. This is the story of Jim Simons, the man who dared to dream, dared to risk, and dared to win. A story that shows us that success is not just about the numbers, but about the journey and pursuit of one's passion. Born in the historically rich neighborhood of Brookline, Massachusetts in 1938, Jim Simons was fortunate enough to have been born into a loving family. As an only child, he was the center of his parents' universe, their beacon of hope after suffering multiple miscarriages. Jim's father, a man who built his life from scratch, taught Jim the value of chasing his dreams. He taught him the significance of doing what he loved rather than what he should, a lesson that Jim would carry into his career as a financier and mathematician. Yet, Jim faced his own set of challenges outside his supportive home. Despite his natural talent for numbers, he was often met with skepticism and doubt from those around him. One day, 8-year-old Jim, with his eyes full of dreams, confided in his family doctor his aspiration to be a mathematician. Yet his doctor, with an amused expression, told Jim he'd never be able to make a decent living with his love for numbers. Nonetheless, Jim's childhood was filled with moments that showcased his unique talent. At the age of 3, he astounded those around him by doubling numbers and dividing them in half, calculating all the powers of 2 up to 1024, just for fun. But despite this extraordinary affinity, Jim found himself working in a stockroom at Breck's Garden at the age of 14. Because Jim's thoughts were always centered around math, he came across as clumsy and aloof, often misplacing supplies. Yet, amidst the mundane tasks, Jim held on to his dream of studying math at MIT. While his own bosses regarded this dream with disbelief, no one could deny that Jim was a smart boy. At the Lawrence School in Brookline, he was elected class president and finished near the top of his grade. Of course, Jim's passion for numbers was not his only defining trait. He was also known for his mischievous side. As a teenager, he once attempted to sneak into a burlesque show with his friend Jim Harple. The two tried to slip away from Harple's house, brandishing binoculars as a cover for birdwatching, only to be busted by Harple's father. This mischievous streak, present since his youth, would persist not only throughout Simons's formative years, but would also color his professional life. In the summer of 1955, Jim Simons, a fresh-faced high school graduate, embarked on a journey that would forever alter his perception of the world. A cross-country road trip with a friend, conceived in the spirit of youthful adventure, would serve as his awakening to the realities of economic disparity and racial prejudice. The Mississippi landscape was a stark contrast to Jim's sheltered upbringing. He watched as African Americans toiled under the sun, their lives confined to the unforgiving cycle of sharecropping. Their homes, nothing more than repurposed chicken coops, stood as monuments of their oppression. This road trip, a rite of passage, became a catalyst for Simons. He recognized the importance of his education, not just as a means of personal advancement, but as a tool to challenge the status quo. With renewed fervor, Jim began honoring his childhood dream of studying at MIT, his natural affinity for numbers paving the way. Yet even in the prestigious halls of MIT, the impish side of Jim refused to be tamed. As a freshman, he once designed a makeshift flamethrower, setting ablaze the college bathrooms. Luckily, the fire was contained thanks to the lavatory's brick walls. Owning up to his fiery prank, Simons ended up paying the school a total of $50 for reparations, a mere drop in the ocean compared to the fortune he'd later amass. Needless to say, Simons' transition to MIT was not as seamless as he had envisioned. Despite his mathematical prowess, Jim found himself floundering in a graduate course in abstract algebra during his freshman year. His classmates seemed to grasp concepts that eluded him, which was an exceptionally humbling experience for Jim. But Simons was not one to admit defeat. He purchased a book on the subject and dedicated his whole summer vacation to mastering the elusive principles of abstract algebra. Hours turned into days, days into weeks, as he wrestled with the complexities of the subject. Jim's perseverance paid off. When he returned to MIT the following fall, he navigated the intricacies of algebra with ease, earning A's in every algebra class that followed. But this isn't the only interesting mathematical concept Jim was introduced to at MIT. Stokes's theorem, a sophisticated evolution of Newton's calculus, also captivated him. It was a theory that involved predicting the interaction of objects as disparate as molecules and gravity. This theory would later become a golden tool in Jim's financial career, as he would similarly use a myriad of data to forecast market trends and amass a fortune. Needless to say, his understanding of Stokes's theorem was top-notch. Other students flocked to Jim for help in this complicated subject, allowing him to weave a network of connections among his peers and make new friends. But Jim Simons was far from your typical college student. He found solace in the solitude of thought, often seen lying prone, eyes closed, in deep contemplation. He was not idle, but deeply engaged in a mental tango with complex mathematical problems. One cold Boston night, Jim stumbled upon two of his professors in the middle of a midnight chat about math at a local cafe. The scene was a tableau of intellectual passion: the cigarettes, the coffee, and the math. It was a life Jim yearned for, a life of intellectual pursuit punctuated by the simple pleasures of caffeine and nicotine. But Jim was not just a thinker, he was also a doer. MIT mandated physical fitness courses, and Jim, ever the nonconformist, chose archery, hoping to spend more time on his math studies and less time changing in the showers. He transformed the mundane into the exciting, placing nickel bets on every shot with his friend Jimmy Mayer. It was a game, a challenge, a risk, a foreshadowing of the high-stakes world of finance that would later become his playground. The same spirit that found joy in midnight math debates and nickel bets was about to navigate the labyrinth of Wall Street. But first, he had to graduate. And graduate he did. Not just from MIT in 1958, but from the confines of conventional thinking. In the summer following his graduation, Jim Simons was not yet the financier who would crack Wall Street's impenetrable code. He was a young man, restless and eager for a taste of the world beyond his textbooks. Jim's plan was audacious, yet simple. He persuaded two local dealerships to sponsor his journey, a cross-country odyssey on Lambretta scooters, the Ferraris of their time. His promise to film the adventure was enough to secure their support. It was an early display of the negotiation skills that would later become useful in the financial world. However, their adventure took a dark turn in Mexico City. They found themselves surrounded by a mob of 50 men wielding machetes. The boys' backs were pressed against a wall, their dreams of adventure suddenly a nightmare. Luckily, the police entered the scene not long after to save the day, but the boys were thrown in jail for disturbing the peace, a far cry from the freedom of the open road they had been chasing. This ordeal left Simons with a newfound appreciation for stability. He returned to MIT, trading the uncertainty of the open road for the familiar hum of academia. But the seeds of adventure had been sown. They would lie dormant, waiting for the day they would sprout and guide him through the labyrinth of finance, where he would make his mark. Back at MIT, Jim's advisor, recognizing the depth of his talent, suggested he move to the University of California, Berkeley. There, a renowned professor named Xing-Shen Chern, a fellow mathematical prodigy hailing from China, would be Jim's mentor. The prospect of learning from such a mind was irresistible, and so, with the weight of his advisor's words and the allure of a new challenge, Jim set his course for the West Coast. But life, with its knack for unpredictability, has a way of complicating things. Barbara Bluestein, a bright-eyed first-year student at Wellesley College, had captured Jim's heart. After 4 nights of talking, the two made the bold decision to get engaged. "We talked and talked and talked," Barbara would later recall. "He was going to Berkeley, and I wanted to join him." The prospect of Barbara moving across the country with a man she barely knew was a tough pill for her parents to swallow. Yet they understood her feelings and reached a compromise. She could go to Berkeley, but marriage would have to wait until her sophomore year. But as fate would have it, when Jim arrived at Berkeley in the late summer of 1959, the mentor he had crossed the country to study under had left for a year-long sabbatical. Jim's disappointment was palpable, and Barbara, watching the man she loved battle his disillusionment, made a decision that would forever change their lives. Ignoring her parents' wishes, she suggested they get married right away. Their journey to Reno, Nevada, was a testament to their commitment. With no money to their name, they borrowed what they needed to make the trip. In a small chapel, under the bright lights of the city, They exchanged vows known only to them. Yet in the early days of marriage, as he continued to pursue his PhD, Jim found himself caught in the throes of a new fascination: the thrilling, unpredictable world of trading. A generous wedding gift of $5,000 had landed in the couple's lap, and Simons, ever the opportunist, saw this not as a safety net, but as a springboard. An avid poker player, Simons viewed trading much like a game of poker, but with a larger chessboard. He plunged into the market, investing in United Fruit Company and Celanese Corporation. These were companies that dealt in tangible things: tropical fruits, chemicals. But the stocks were stubborn, their prices barely shifting, and Simons found himself straining at the leash of his own impatience. His broker, sensing Simons' restlessness, suggested a pivot: soybeans. This suggestion was a leap into the unknown for Simons, who had no prior knowledge of commodities or futures trading. Yet, he took to it with the hunger of a man starved for challenge. He bought 2 futures contracts and watched as the price of soybeans skyrocketed. The profits rolled in, and with them, a sense of triumph. Just like that, Jim was hooked. A friend, seeing Simons' growing obsession, offered a word of caution. Commodities were fickle, he warned. But Simons, bitten by the bug of success, brushed him off. Yet when the price of soybeans plummeted, it wasn't disappointment that Simons felt, but a sharpened desire. His days took on a frenetic rhythm. He would rise with the dawn, driving to San Francisco to be at Merrill Lynch's office by 7:30 a.m. He stood for hours, eyes glued to the flashing numbers on the big board, making trades in a world that moved at a dizzying pace. Even at home, his mind was on the market, the thrill of the trade never far from his thoughts. But life, in its relentless march, began to tug at Simons. His studies demanded his attention. His wife, Barbara, was pregnant. The balance he had been precariously maintaining began to falter. With a heavy heart, Simons stepped away from trading. Yet, this was not a defeat, but a retreat. For even as he stepped back, Simons was not leaving the game. He was simply biding his time, waiting for the moment to dive back in, armed with lessons learned and a hunger that had only grown. In the early 1960s, Jim Simons, freshly minted with a prestigious teaching position at MIT, was perched on the precipice of a promising academic career. His wife and their newborn, Elizabeth, had joined him in his move to Cambridge, and, to the casual observer, their life was a picture of perfection. Yet, beneath the happy family man facade, a restlessness stirred within Simons. He felt a cold dread at the prospect of his future laid out for him, a monotonous stretch of teaching and research, devoid of any fresh challenges or triumphs. At the tender age of 23, Simons found himself already grappling with an existential crisis. In search of answers, he briefly left MIT and journeyed back to Bogota, hoping to tap into the entrepreneurial spirit of his Colombian schoolmates, Eskenazi and Maya. Simons had noticed that most Bogota flooring was of incredibly low quality, and he saw a glowing business opportunity. Together, the three started a Colombian floor tile company that made and sold vinyl floors to the Colombian market. However, it was a venture that appeared to be in good hands and didn't need much of Simons' contribution. And so, the allure of academia called him back. In 1963, Jim Simons accepted a research position at Harvard University. At Harvard, Simons was a paradox. He was a beloved figure, known for his quick wit and casual attire, a stark contrast to the stiff, formal demeanor that was the norm. But behind the laughter and the jokes, Simons was wrestling with his own demons. His research was stalling, and he felt out of place in the Harvard community. As Simons navigated the labyrinth of academia, he was struck by a realization. Wealth, a concept not valued by his fellow academics, was not just a marker of success. It was a ticket to independence and influence. As Barbara would later recall, Jim understood at an early age that money is power. He didn't want people to have power over him. One day, in the quiet solitude of a Harvard library, Simons made a decision that would alter the course of his life. He would leave academia behind and embark on a new journey, one that would combine his love for math with his yearning for adventure. In 1964, Jim Simons left Harvard for a clandestine government intelligence group. tasked with outmaneuvering the Soviets in the Cold War's shadowy chess game. At the Institute for Defense Analyses, Simons found himself submerged in a world of numbers and codes. He was taught to develop mathematical models that could tease out patterns from a sea of seemingly meaningless data. Yet in the middle of this new venture, Simons was, as always, yearning to do something bigger. He saw the burgeoning potential of computing power, while the world of securities trading remained old-fashioned, clinging to antiquated methods of card sorting for accounting and other operations. A vision soon took shape in Simons's mind, a company that could harness the raw power of technology to trade and research stocks. Simons pitched his idea to his boss, Dick Liebler, as well as the IDA's top programmer. They were swept up in his enthusiasm and agreed to join his venture, which he named iStar. But even the most compelling vision needs fuel, and Simons found himself unable to raise the necessary capital. iStar remained a dream, an idea that never quite found its footing in reality. Yet Simons was not at all disheartened by iStar's failure to launch. His research on minimal varieties, a niche within the realm of differential geometry, was beginning to bear fruit. It was at this point that Simons began to see the world through the lens of statistical analysis and probability theory. It was here, in the sterile government offices, that the seeds of his future trading prowess were sown. But after an unauthorized interview with Newsweek, Simons found himself fired and jobless, with 3 young mouths to feed and an uncertain future. That's when Simons found himself at a crossroads. He confided in Leonard Charlap, a friend and fellow mathematician, about his fears and aspirations. Teaching, he felt, was too mundane, too safe. The prospect of joining an investment bank selling convertible bonds held a certain allure. Charlap, however, was less than enthusiastic about this idea. He saw in Simons a brilliant mind, not a Wall Street salesman. One day, a letter arrived for Simons from John Toll, the president of Stony Brook University, a public university on Long Island. The offer was tempting, a chance to build a mathematics department from scratch. So in 1968, at the age of 30, Simons moved his family to Long Island. He embraced the challenge with gusto, charming recruits, and building a department that would soon rival the best. For a while, he left the world of finance behind, choosing instead the familiar rhythm of academia. And in the hallowed halls of Stony Brook University, mathematicians and students alike found a quirky friend in the form of Jim Simons. A man who, despite his towering intellect, chose to eschew the formal attire that was the norm among his peers. Even during the frigid New York winters, Simons never wore socks, his bare ankles peeking out from under his trousers. In 1976, Simons, a mathematician as brilliant as he was eccentric, won the Oswald Veblen Prize. This accolade, bestowed by the American Mathematical Society for outstanding contributions to geometry, is the mathematical equivalent of a Nobel Prize. A testament to his genius, it was a triumph that appeared to set the stage for a long career in academia. However, beneath his mathematical prowess and affable exterior, Simons was a man grappling with restlessness. At 33, he was a man in his prime, yet he was facing a familiar sense of discontent. His mischievous nature, present since childhood, came to light as whispers of his infidelity circulated within the university, rumors of a clandestine affair with the department's secretary. At home, his wife Barbara was battling her own discontent. She felt overshadowed, trapped in the shadow of her husband's brilliance, her own ambitions stifled. The discovery of her affair with a younger colleague, a man Simons himself had brought into the fold, was a devastating blow. It was the final nail in the coffin of their marriage, a painful end to a chapter in their lives. For Barbara, this was a fresh start. Finally free to chase her own ambitions, she would become a national expert on security problems in computerized voting. She once recalled, "We just married too young. My parents were right." For Simons, this period of personal turmoil was a crucible, a testing ground that would shape the financier he would become. He sought the counsel of Charles Freifeld, a former student of Jim's, and a man who had made a name for himself building econometric models that could forecast commodity prices with uncanny accuracy. Simons, alongside his partners, invested a sum of $600,000 with Charles Freifeld. In a span of 7 months, Freifeld, with his deft handling of sugar futures, managed to multiply the initial investment by 10. The humble $600,000 had now metamorphosed into a staggering $6 million, thanks to his ingenious model. But how did this math model work? Let's say crop production takes a nosedive. Freifeld's models would compute the likely price surge, allowing them to profit when the time comes. It was a nascent form of quantitative investing, a strategy that would later become Simon's calling card. This strategy caused money to roll in, giving Simons a heady mix of success and validation. The rush he felt trading reminded him of the days he'd spent at Merrill Lynch's offices before Barbara got pregnant. According to his friend Mayer, Simons had got the bug. It was the first time he realized that finance could be a powerful tool for multiplying his wealth. And so Jim found himself standing on the precipice of a new beginning. The Colombian tile company he'd birthed with his pals in the early 60s had just sold a 50% stake, and the profits were substantial. Simons saw a fresh opportunity in this newfound mountain of capital, along with his earnings from Freifeld. In 1978, he made a decision that would alter the course of his life. He decided to permanently step away from academia, leaving behind the world of equations and theorems to carve out his own path. Simons started his own investment company in a storefront office in the back of a strip mall, focusing his sights on the world of currency trading. He named this new venture Money Metrics, which he built along with a hedge fund called Limroy. The concept was simple. Money Metrics would act as a testing ground where Simons would invest a modest portion of his own capital into diverse markets. If these strategic forays yielded profit, he'd replicate these same moves on a larger scale in Limroy, a bigger fund that would also cater to outside investors. These new establishments were a leap of faith into the financial world. Of course, the prospect of Jim Simons, the esteemed mathematician, abandoning academia to play the high-stakes game of the market was a notion that drew a collective gasp from his peers. Even his father, the man who had instilled in him the courage to follow his heart, found himself deeply disappointed. He had always found a certain pride in introducing his son as a scholar rather than a businessman. Simons, however, was no stranger to the feeling of letting others down. He would later reflect, "I've always felt like something of an outsider, no matter what I was doing." Hungry for success, Simon's first move was to find a partner who could match his ambition. His choice fell on Leonard Baum, a fellow mathematician and co-author of the IDA research paper. This move, much like his decision to work with Freefield, was emblematic of Simon's unorthodox approach to hiring. He always favored the analytical rigor of mathematicians over the gut instincts of traditional traders. But why hire Leonard Baum in particular? Baum had a knack for discerning hidden stats and making predictions in chaotic environments, a skill set that promised to be invaluable in the volatile world of finance. "Let's see if we can make a model," Simons proposed, and the two prepared to tackle the markets together. Thus, the stage was set for a daring venture into the financial world. Baum developed a mean reversion model, a system that predicted the ebb and flow of currency values based on their historical averages. Needless to say, it proved to be a goldmine for Simons and his fledgling firm. The British pound was the first to yield to Baum's astute predictions. As the currency soared, so did Money Metrics' profits. The Japanese yen, the West German Deutsche Mark, and the Swiss franc followed suit, dancing to the tune of Baum's insightful model. After tasting the sweet success of early currency trades, Simons decided to add US Treasury bond futures into Money Metrics' trading portfolio. He and Baum promptly assembled a select team to take on the job. Their mission, to construct intricate models capable of sniffing out lucrative opportunities in the volatile terrains of currency, commodity, and bond markets. But success, Jim was soon to learn, was a fickle mistress. Their models, once a beacon of accuracy, began to falter. The competition was growing fiercer, the financial landscape was shifting, and persistent price movements were becoming the norm. Assets were no longer reverting to their mean as expected. Simons promptly hired a 19-year-old computer programmer, Greg Hollander, to track the firm's losses. Within 6 months, the numbers revealed a worrying trend. Baum's shift to bond trading had gone awry. The losses were piling up. Yet in the face of adversity, Simons' resolve only hardened. "There's a pattern here. There has to be a pattern," Simons persisted. Jim and Baum worked tirelessly to develop a new model, which they ended up calling the piggy basket. This system was designed to consume vast amounts of data and use linear algebra to make trading recommendations. For a while, the piggy basket seemed to be the answer to their problems. Profits were once again on the rise. Then, an odd twist occurred. The piggy basket, in a puzzling move, started pouring a vast majority of its resources into potato futures contracts. This represented millions of pounds of Maine potatoes, warranting a frustrated phone call from the Commodity Futures Trading Commission. While Simons maintained a good sense of humor about the mishap, it signaled the end of the once successful piggy basket strategy. Now the year was 1982, and Baum's discretionary trading style had lost the firm a lot of money. Jim Simons decided it was time to try something entirely new. He sought to delve into the uncharted territories of tech startups, the emerging industries that promised to redefine the world. Thus, Moneymetrics became Renaissance Technologies, a name echoing the rebirth of ideas and the dawn of a new era. Of course, Simons was not a man to tread lightly on new paths. His first move was to bring aboard James Axe, a mathematician with an unconventional perspective. Axe was no financier, but Simons saw in him a kindred spirit, a fellow pioneer unafraid to challenge the status quo. Meanwhile, issues were arising with Baum. He was a man of relentless optimism, a trait that often led him to clutch onto investments for too long. One day, in the midst of a gold rush, Simons found himself at odds with Baum. He urged him to sell their stake in gold, but Baum, ever the hopeful, believed the tide would only rise higher. In a desperate bid, Simons had to physically place the phone to Baum's ear, forcing him to tell the firm's broker to sell. The move was timely. The gold market collapsed in a matter of months, vindicating Simons' foresight. However, Baum's unwavering faith in the buy low, sell high principle began to cost Rentech serious amounts of capital. The losses became too great, and in 1984, Baum, with a heavy heart, decided to leave Rentech. Luckily, Axe proposed a new model, one that hinged on machine learning and probabilities. The idea of using machine learning in finance was virtually unheard of at this point, making Rentech a true pioneer in the world of quant trading. And while it was a gamble, Simons was a man who thrived on taking risks. Their strategy was simple yet revolutionary, using data to identify patterns and anomalies and leveraging these insights to make trading decisions. Integral to their strategy was Sandor Strauss, a master of data whose tenure stretched back to the company's infancy. His relentless pursuit of data accumulation was the secret sauce that gave Rentech its competitive edge. Without Strauss, their quantitative strategy, the golden goose of their profits, would have been a mere shadow of its potential. Yet things were not rosy just yet. Simons's first hedge fund, Limroy, was being met with a chorus of investor concern, their faith in his venture capital picks wavering. This led him to a bold decision. In 1988, Simons shut down Limroy and, from its ashes, gave birth to a new venture, the Medallion Fund. However, Jim quickly realized that he would need to seek out a new leader for his fledgling firm. Tensions were growing as Axe became increasingly resistant to Simons' strategic advice, particularly his push for a shift towards more volatile, short-term trading. This stubbornness sparked relentless bickering between the two, resulting in Axe's abrupt departure from the Medallion Fund in 1989. This led Simons to Elwyn Berlekamp, a game theorist who advocated for short-term trading. Berlekamp, like Axe, was not a traditional financier. He was a strategist, a man who saw the market as a grand chessboard. Berlekamp did well, with Medallion yielding a 55.9% gain in 1990, but Simons was a man who did not settle for well. He wanted to make billions. Jim's constant prodding and relentless pursuit of perfection eventually led to tension between him and Berlekamp. Feeling the pressure and growing tired of non-stop calls from Jim, Berlekamp suggested that he buy him out and take full control of the Medallion Fund. And so, in the year 1990, Jim did. Now he was back at the helm, steering the ship into the unknown. In 1993, Simons found himself teetering on the edge of a choice that would redefine his career. He had been wrestling with the idea of delving into the world of equities, and his first instinct was to borrow a page from Berlekamp's playbook. However, it quickly became clear this venture would demand a new model of operation, as this model failed to yield the returns he had anticipated. In the face of this setback, Simons turned his gaze towards the horizon, where the untapped potential of scientific innovation beckoned. IBM was a titan in the world of technology, and it was from their ranks that Simons plucked Peter Brown and Robert Mercer. The two were computer scientists, not traders, another classic move by Simons to avoid hiring financiers. Mercer and Brown took 2 years poring over vast amounts of data, seeking out correlations and relationships in the market. Then, in 1995, they experienced a breakthrough. The elusive pieces of the puzzle finally fell into place, and the Medallion Fund, under a new model developed by Mercer and Brown, soared by a staggering 98.5% in the year 2000. Yet Simons stood on the precipice of disaster. The tech bubble, a sphere of inflated hopes and overvalued stocks, burst in March 2000. The Nasdaq, a once mighty titan, had been humbled, its value plunging 25% in a month, a harbinger of the 78% crash from its zenith. The financial landscape, once familiar and predictable, had transformed into a treacherous terrain of uncertainty. Simons' fund, Medallion, bore the brunt of this seismic shift. In the span of 2 days, it hemorrhaged $170 million, a financial bloodletting that seemed to have no end. The losses, like a merciless tide, surged towards the $300 million mark. Simons, however, was not a man easily swayed by the storm. "Trust the model," he implored his team. "We have to let it ride. We can't panic." His words were the embodiment of resolve, the unyielding spine of a man who had weathered many a financial storm. Yet, upon a little more self-reflection, Simons acknowledged a revelation. In the throes of a market crisis, the old ways often falter, and new paths must be charted. The model, his trusted compass, needed recalibration. With the courage of a pioneer, Simons and his team ventured into uncharted financial waters. They adjusted their model, casting aside the momentum strategy like an outworn cloak and re-examining their data sets to forge a new path. Needless to say, the gamble paid off. The Medallion Fund rose from the ashes of its losses like a phoenix, and the rest was truly history. In the year 2000, Jim Simons stood atop a financial empire that commanded $6 billion. His hedge fund was the envy of Wall Street, a titan in a sea of giants. Simons, a man once told he'd never make a living studying math, had defied the odds. Medallion soared by a whopping 99%, a staggering feat in the financial world. To put it in perspective, Medallion's performance even eclipsed that of the legendary financiers George Soros, Julian Robertson, and Paul Tudor Jones. Over the course of 30 years, they amassed an average annual return of 62%, outpacing even the formidable Berkshire Hathaway. Warren Buffett himself, a man known for his skepticism toward day trading, once tipped his hat to the Medallion Fund's success, conceding they were very smart. The new millennium brought no relief for Simons' rivals. In 2001, Medallion rose again, this time by 33%, dwarfing the S&P 500's average gain of 0.2% over the same period. Even other hedge funds, with their average gain of 7.3%, looked pedestrian in comparison. But by 2010, Simons, true to his character, was ready for a new chapter. He retired, stepping back from the day-to-day operations of Rentec, the firm he'd built from scratch inside of a strip mall. He remained an advisor and non-executive chairman, a guiding hand rather than the driving force. 9 years later, in 2019, he withdrew further, retaining only a board membership. Yet for Simons, retirement was not an end, but a new beginning. Alongside his wife, Marilyn, who was initially hired as his children's nanny following his divorce, he shifted his focus towards philanthropy. The Simons Foundation, their brainchild, has since contributed over $4 billion to causes close to their hearts. Among these is Math for America, a non-profit that supports educators in the fields of math and science. It's a fitting tribute to Simons' own journey, a testament to his belief in the power of mathematics. Today, Simons is a fulfilled man. A multi-billionaire, he enjoys the freedom that comes with financial independence, indulging in yacht trips and the finer things in life. But more than the wealth, it is the vindication that brings him joy. He has proven the naysayers wrong, showing that one can follow their passion and still find unbelievable success. In the end, James Simons' story is not just one of financial triumph, but a testament to the power of perseverance. You see, Jim Simons didn't just conquer the market, he redefined the boundaries of possibility, proving that with the right blend of passion and courage, one can indeed shape their own destiny.